So we had an exciting session in the morning, and Deputy Governor Rajeshwar Rao gave a perspective about how to develop the credit markets and how to proceed with securitization. And we had the MDs and CEOs also giving their remarks and reactions to the thing. We have requested the esteemed panel of bank CEOs and MDs to stay for this more freer panel discussion. Morning we had the perspective from the regulators, and now we'll have a perspective from those who are regulated and those who actually create value in terms of the finance business. And I would request them to give their very free assessment. They can actually tell whether they are on the same page as the regulators or not really. It's a healthy debate is always welcome, because that's how policies get refined and stuff. So feel free. You can have a smiling or a furrow-browed face, is entirely your choice. So I'm not going to sort of restrict anything on this. You can even have a angered or a ballistic emoji sort of thing in words. But we really, as students here and teachers here, we want to understand what really is constraining the banks. Is the regulation really up to the mark? Is regulation ensuring a platform where financial stability is not at a risk? So individual entity failures might take place, but that too needs to be avoided, because essentially it's the depositor who loses money. And as I made a comment in the morning, that basically if it's all about also government and all about people in particular, because if banks are recapitalized, then obviously that's on the fiscal burden which a taxpayer pays, and the depositor loses money. We now have a sort of a kind of an amendment to there was an amendment in the DICGC bill. We couldn't have an FRDI sort of thing, a resolution mechanism for financial institutions. But some reforms have been done, and at least banks which had gone under the resolution, those depositors have started getting money back. So it's a step forward, maybe not complete. I think let me in this context first request a 2 to 3 minute statement from each of you on what do you think have been the significant strides in bank regulation since the global financial crisis, and two, what are the two major things that you see? So maybe two positives and two negatives. I think who wants to go first? From a global perspective, I think maybe Ravi, Mohan will say, and then from your side, we'll have your perspective.
Good afternoon. After lunch, I know the condition. So I don't want to sit and talk, and I don't want you to sit and listen. But you don't have a choice, but I have a choice. So I think I will stand and talk, right? So thank you very much, for coming back after lunch, which I thought will be much less, but I find a reasonable amount of people trekking in. So any seminar, lunch is the biggest problem, and after lunch, the attrition levels become much higher. So here at least, we have a reasonably substantial number of people attending this. So thank you very much. So I will talk about, I do not want to talk, about what we spoke in the morning. Let me tell you a little bit of the international perspective on regulation after not the global financial crisis that you all know, So after global financial crisis, you know that the standard setting bodies like the Basel Committee, the Financial Stability Board, the International Accounting Standards Board, they all came up with a large number of regulations which were tightening the financial system, the accounting standards, etc. But after the current pandemic, the COVID-19, which is of course nothing to do with finance, but ultimately it's a health related thing which ultimately affected the entire globe. So there were the standard setters also came up with something. But more than that, I will say it was the International Monetary Fund which came up with a large number of policy related guidance for the regulators, for the supervisors, for the banking systems, for countries after the crisis. If you get some time, just Google the IMF website. It is very simple, www.imf.org. So you will get the IMF website. On the top, there is a menu bar called Policy COVID-19. And under that, you will find all the policies which came in different areas. Not only in regulation and supervision, but on fiscal policy, monetary policy, everything under the sun, which the IMF came up with this. And since just before COVID, I was working for 5 years with the IMF as an advisor in the area of financial sector regulation and supervision. In 2020 and 21, the fund did a large number of roundtables because there was no question of travel. So these roundtables were region specific. One was for Asia Pacific, then for sub-Saharan Africa, the Caribbean countries, for Latin America, for Eastern Europe, etc. So I had an opportunity to do many of these roundtables and understand how countries are formulating their regulation during this pandemic. And in the fund IMF paper on policy, they have consolidated how many regulatory changes, how many regulatory modifications that countries brought about. And from about 100 and odd countries, there are, if my memory is correct, more than 800 policy stipulations, including moratorium, including restructuring, including accounting standards, etc., etc. So the theme of all this is to what I will say, I will not say deregulate, but to relax many of the things which were put in place after the global financial crisis. Why? Because after the global financial crisis, things have been made very, very tight. The bank's capital position was comfortable, liquidity was very good, so they could relax a little bit. But in formulating these policy prescriptions, normally it should be the Basel Committee or the Financial Stability Board or individual regulators who come up with policy related guidance, isn't it? Even the Basel Committee guidance is not enforceable by law. It's more like an agreement between the countries that these are requirements which brings your banking system to the best international practice. So that is why every country abides by that. So the IMF brought out certain cardinal principles to guide the national regulatory and supervisory process during this crisis, and there were 7, 8 or 9 issues. First one was use the embedded flexibility and uphold minimum standards, which means
Ravi, my request is, it's very good you told the students, because the students would probably go and dig the sites and learn more and more. But we won't have time to discuss 7 or 8. So what are the two biggest steps which were taken, and what are the two big chinks do you see?
okay. So if you look at this from that perspective, two of the biggest things which happened internationally and also which India also followed. The first one was, to ensure that there is credit dispensation to the most, the most desirable segment of the society. Okay. How did that happen? That happened by means of the support from the central bank in some countries, the support from the government in some other countries, the relaxation of some of the requirements like capital adequacy requirements beyond the Basel requirements, relaxing the liquidity requirements beyond, whatever is the minimum. But there was a benchmark that it should not come down below the requirement, okay. So this was the first one, I will say, relaxing the prudential requirements, relaxing the credit dispensation standards to some extent, asset classification, provisioning, etc., so that banks could continue to lend, to the most desirable, needy, segment of the society. The second one I will say was to ensure that what I will say, the supervision and the regulation of these entities continue to be done even during the pandemic, where on-site visits were not possible, and it was mostly on a work from home type of situation, to ensure that these type of activities happen. At the same time, manage all these new type of risks which are coming at that time, especially cyber risk, because everybody was working from home, so there was lot of chances of somebody hacking into the system and access controls and things like that. So cyber security, IT security, and also the most important thing as part of the second, I will also say that the resilience became the key thing. So whether it is the Reserve Bank of India, whether it is any other regulator, they put a lot of emphasis on how the financial system can be resilient. So I will say these are the two most important things. If you ask me what are the negative, I will say all across the globe, all across the globe, not only in India, in regulation there is a small issue, I hope all of you understand Malayalam, right? There is, others can translate for you. There is a very famous saying, that ഒരുത്തൻ പാപകർമ്മം ചെയ്തിടിൽ അതിൻ ഫലം പരക്കെയുള്ള മഹാജനങ്ങൾക്കൊക്കെ തട്ടും. Have you heard this? If one fellow does some bad thing, its impact will be felt across the society. So there have been many instances where the regulator comes across something and puts something in place, and it affects the entire people. And this has been little more prevalent during the last few years. I don't want to say the instances which happened in India. All of us know that. Many of you also know that. So for example, anyway, Rajeshwar Rao is not there, so I can say, so this current account dispensation, there must have been some problems. So the restriction, when it came, it is affecting all of us. So there are certain things, but we feel that persuasion and taking up with the regulators may help this.
I think
So,
Mr. George may have something to comment on the current account. Anyway.
Okay. So I will stop here. There are, of course, there will be many other, time to interact with you. So let me stop here. So basically the two positive things, I will say the most important positive thing, ensuring the uninterrupted flow of credit to the most productive segments of the society, so that the real sector is not affected. I will say this. So you can say any number of things for that. Prudential requirements, asset classification, provisioning, restructuring, the requirements given.
Let me move to the other panelists also. We got the
okay,
message very clearly from your side. Thank you.
So I will stop here. So we will have some issues to discuss, later.
Yeah, and my request is we can just rotate the mics and we can make it more freewheeling discussions. Mr. Murali, from your perspective, from the Indian bank's perspective.
I think one of the important lessons which we learned from the 2008 global crisis was, if you were to put it in simple terms, one was leverage and second one was liquidity. These were the two big issues which cropped up during 2008, and why it happened, I'm sure all of you know. It was a subprime crisis which happened. Basically, the government, in order to boost the economic activity, they said that you can give loans to subprime category, which basically meant no income, no job, no asset. That group was the one which was getting predominantly funded by banks. And these were all mortgaged backed securities. So essentially the loans were given to subprime, and these loans were then sort of put together, and they were all given higher rating by many of the institutions, and people who had invested. People, basically the PF and I mean these provident fund companies, insurance companies, they were all the investors who bought this thinking that it's a AAA or a AA security. But then eventually when repayment started happening, these people are not able to pay, the borrowers not able to pay, it resulted in huge crisis, which had a ripple effect across the globe. So that was the essential thing. And so this clearly shows that whenever an economic activity is far where the lending activity is far outstripping the normal economic activity, there is bound to be this kind of issues happening. So one needs to be very cautious as to whether the push side lending, for example, today you have fintechs, you have small banks, you have NBFCs, you have large banks, and everybody is wanting to go and lend. So it's quite possible that if you regulators don't have a fix on this, it's quite possible that somebody might be over leveraging. Somebody might be getting overfunded. That can lead to delinquency and risks firming up. So this is what actually led to this crisis, and then of course lots of changes happened. If you look at India specifically, I think the biggest change was AQR, which was brought in 2015. AQR is basically asset quality review, where banks were clearly told to classify, have a review of various assets, and each bank was asked to come out with their BB rated, how much of portfolio are they carrying. So first time probably market also got to know about what each bank is carrying by way of huge BB and sub investment grade assets they were holding. And the second big change which happened post that was, post the global crisis, was LCR. Liquidity is another issue which happened. Therefore, LCR came as a requirement. And LCR is liquidity coverage ratio, where you are supposed to keep at least 100% as a immediately liquefiable secure assets, which you can to get over the any liquidity crisis. So this also was one of the big changes which was brought about post global crisis. But while all these were happening, there were also changes in the way regulators were looking at the banking system. There was a time when regulators were looking at what we call loosely as CAMLs, capital adequacy, management. These are the asset quality, management, earnings, liquidity systems. This was used as a methodology to assess how good a bank is. They were basically assessed on these parameters. Subsequently, regulators also started replacing CAMLs with another called SPARK. This again, basically way of regulating the entities which are to be regulated. So there is a sea change in the way regulations have started coming in, and sea change in the way the whole thing was looked at in terms of capital adequacy, in terms of, there was another factor which was brought in was CCB, capital conversion buffer. Basically, it was basically to add another 2.5% over the, on risk-weighted assets over the tier 1. So you know that banks' strength is decided by capital adequacy. Capital adequacy consists of basic equity, and we call them tier 1 and tier 2. Tier 1 is a basic core equity part of the banking system. There they added this 2.5% over and above the regulatory requirement in order to ensure that there is a sufficient capital buffer built in so that crises don't happen and banks don't go down under. This was so today if you say RBI is looking at, let's say, 9.5% as the regulatory capital required, regulatory CRAR required, if you add another 2.5% over that, you are looking at something like 11.5% for is the minimum which we need to keep assets. So these are some of the positive changes. Two things which in my view, I won't say negative, but unfinished agenda I would say is, today with the rapid technology changes happening, etc., lots of entities have come in to play a part in the financial system. So lots of outsourced agencies are getting involved. So there are, and lots of technologies getting involved. So in technology companies where banks go and have a relationship with, these technology companies in turn go and outsource many of their things. So the risk actually has to be assessed as to where these people deal with, whether they are good enough to be carrying out, having proper checks and controls. So all that is it's in a way like you need to really understand fully the cycle in order to have a grip on what is going to happen. So that is one thing which still we have a long way to go in terms of looking at that. And the second one is, of course, the resilience or IT resilience risk. Basically, the cyber security kind of thing. You can see today that in our own bank, we are seeing that many of the customers were lured into small financial gains by fraudsters calling them up and saying that we will offer you a job, we'll make you earn extra 10,000 rupees, 5,000 rupees. Please go and see this YouTube and then put your comment, we'll immediately reward you. All these are easy money schemes luring investors, luring borrowers who believe that this is something which is real, because they are lured by actually money getting transferred to them during the first or two transactions. Thereafter, they've been asked to put in a lot more money and they eventually lose money. So this is something which is hugely impacting across segments. And therefore, IT resilience risk is another big risk, which is a real risk today. So I believe that it is buyers beware. You shouldn't fall for it. Your relatives and friends shouldn't fall for it. Nothing comes easy in life. If it comes easy, it will also go back very easily.
Okay,
So,
I know the third party issues and their regulation is an important area. Time permitting, we'll come back to you. But maybe, yeah, George, Mr. George will.
Thank you.
give his perspective.
First of all, I would like to correct something. I am not George, I am Alexander. George is my father. The ulta. In Malayalam, it is ulta. So when you go to school, you say George is the son for Alexander. In English, it is Alexander, son of George. So don't worry, it's not your fault, it is my fault. I have corrected my son. My son is George Alexander. Okay, so I just wanted to make it a little interesting. Here, I have on my left side, he is an ex-RBI person. He is an ex-RBI person, all regulators. This is a bank person. I am the only entrepreneur here.
So you can criticize the regulator.
To me, these people are necessary, but without me, nothing will run. When people come and say, you should not do this, you should not do this, then I say, what will you do? What are you going to do? You're going to do farming. You have come to do business here. You have to learn to work within the regulation. If all these people, I take all these people on my board, my company will not move forward. They will say, don't do that, don't do this, don't do that, don't do this. They are don't people only. But to me, yes. But then we need good regulations also. We need good comforts. India has done a good job as far as the RBI is concerned. Over the last 10, 15, 20 years, we have not had any big bank problems, etc., thanks to the regulator. But then I was just looking at what the topic here is, regulation of the Indian bank system have recent strides bulwarked. So I was thinking, what is this bulwarked? So I looked in the dictionary, what is this bulwarked? It says fortified. So again, they are here to fortify things. I'm sure I was asking him, who are the audiences? They said they are all students. I don't think all of you to go and join a regulator. Are you all going to become RBI employees of RBI and regulate things? I thought you are going to the market, to the field, to probably work, make some business, make some money for the company where you are working. These are required.
But to make money, they need to understand regulations.
No, to keep money. To make money and keep it with you, you need regulations. So I was not saying that regulations are not important. I only said, yes, today's regulations are good. They need to do much more. But then there need to be a line also where, is it over-regulated? Is it regulated as per requirement? You heard Mr. Ravi Mohan saying about what happened earlier, and of course, one person does anything wrong, the RBI will come. So when any circular or modifications come from RBI, etc., I'm 100% sure it is because of some instance which has happened. They'll say, don't do like this. It means that X company has done this. They have not. So don't do like this. But then what happens is, in that, something like you are killing the child by throwing away the water. So you are not, when it may not happen in this case, but it will not happen in all the other cases. But everybody gets painted with the same brush. So that is my concern here, or my request here, that the regulators, they should do it, but they should do it looking at what is there. So I'll come to our company.
So can I ask you one specific question?
Yeah, please.
Like you said,
I actually
everybody.
want them to ask.
No. Everybody. I'll open the floor soon. So, like you have this grudge that everybody is painted with the same brush. Now, the RBI has come up with scale-based regulation for NBFCs. So everybody is not painted with the same brush, but probably a large NBFC like yours is on same page as far as the intensity of regulation is concerned as large banks. Now, what do you think is missing in this? How should this be corrected if that is your grudge?
Okay. When you come to scale-based regulations, we are treated as a upper layer in BFC. Only 16 companies are there, NBFCs are there in India. The top 16 NBFCs, including Muthoot, is part of the 16 upper layer companies. So everybody was talking about regulatory arbitrage. So when people say NBFCs have a big regulatory arbitrage, that means they are less regulated than a bank. But when it comes to an upper layer NBFC, we are almost equally as tightly regulated as a bank. But then as an NBFC, this is the regulatory arbitrage which is again working against the NBFC today. Against the NBFC, what is working is, we are not permitted to take deposits. Why is that? Why is NBFC not permitted to accept deposits? Where banks which are equally regulated, they are there. Again, we give gold loans, security against gold. So there is a risk weightage for any loan. If you give a loan, personal loan, the risk weightage is 100%. That means if you give 100 rupees personal loan to somebody, the risk is, the maximum risk is 100%. So that is the risk weightage. For a gold loan where the gold is a security, actually there is no risk in it. Because the gold is there, it is pledged, there is no risk. If an NBFC gives a gold loan, the risk weightage is 100%. So if we give 100 rupees loan to somebody, we have to provide for 100% risk capital. The same customer goes and pledges with South Indian Bank, the same gold. The risk weight is 0. The same customer, same ornament, same currency he is giving also RBI currency. We are also giving RBI currency. For him, risk weight is 0. For NBFC, risk weight is 100. What is that?
Wear the old hat and react to this?
No, so it doesn't have, I only said, sometimes when you bring regulations, you must bring it looking at these things also. Not that this is going to hamper a business, etc. We don't mind, but then it only means that we have to have more capital. We have to have more capital to take care of such a risk. So I will just leave this open here. Anybody can ask questions, etc. I thought I will make it a little more interesting.
Now, while he is right that gold, clearly banks getting into gold loan competes with NBFC, but just to tell you, what we can charge ever for a gold customer is not more than 10-11%. What they can charge is as high as 24%. So they have enough to earn and therefore enough to keep that aside. So therefore it's all, and finally where do they come and take money? They take money from us. Today they can't raise deposits, so they raise, of course, owners like Alexander will put his own money, but then they also need a lot of debt. Where does that debt come from? It's coming from us. So we give money on one side and make them earn 24%. We ourselves earn only 11%, and we also buy assets from them and give them at 9-10%. So in a way it's all going to them only.
And since I had this opportunity of working with the supervisors and regulators in different jurisdictions in the world, and where many of them are facing problems with the non-banking type of entities, and they all and this Indian model is something which now they have appreciated considerably. If you look at, we also had hundreds and thousands of non-banking companies in our country. So we slowly started the process of registering them, asking the most unviable, people to get out of this business. The others, having a particular level of assets and net on what you call net on funds to get registered. Then we slowly started regulating the liability side first, how much net on funds and how much deposits they can accept and things like that. And then came to the asset side slowly, but then over a period of time, the asset side for systemically important non-banking companies like Muthoot, it has been made almost similar to a bank. And we set up a non-banking finance department in the Reserve Bank of India, which is, I will say, almost as strong as the banking supervision department. So with these things, registration, bringing down the numbers, liability side regulation, asset side regulation subsequently, then, the bigger ones, all as good as a bank, including corporate governance and everything. So which means if Muthoot is now, or I will not say take the name, so if any of these systemically important non-banking finance companies, they are competing with the banks, that is because of the inherent strength given to them by means of this regulation. And I will say that. Of course, there may be instances, like he points out, there may be, regulation never is perfect. So there may be instances where there are some irritants, which of course the method is constant dialogue with the regulator, and at some point in time the regulator may feel that there is some logic in what the regulatee says and may change some of these things. So this is something which we have to, as regulatees now, we have to keep on requesting with logic and rational to the regulator, right?
I think we didn't allow Alexander to have enough option of talking about the chinks, etc. So if you want to finish that part.
So you were asking about, the second part is fortification of the system. Second is chinks remaining in the system. The chinks, I think you would have meant what is left to be regulated. That what is meant by that? I would think the other side only. Unfinished regulation. That means more regulations.
One which causes fissures in the financial system, a regulatory gap which causes fissure in the.
To me, I would put it positively. The chinks which remain is what changes you should make to be less regulated. So, yes, because everybody here was talking about credit risk. Credit risk is when you give a loan to somebody. So, I heard, I think you or the Deputy Governor saying about the special transferring a loan through a special purpose vehicle to others. See, what happened in US in 2008? They gave all these loans, housing loans to people. They gave the loan to a housing person when the house price was $100,000. So he borrowed $100,000, 100% he borrowed. After 1 year, the price of the house went up to 150. So he went and borrowed 150. After another 6 months, the house price went up to 200,000. So he went and borrowed and he spent that money. After some time, the house prices started coming down. When it started coming down, all these banks who had borrowed this, they parceled it out to others as securitization special purpose vehicles. So bond, and they gave it to all the people. All those people who subscribed to the bond. Finally, the bond price became zero. Banks failed, and that was the failure of the Lehman Brothers. They were the biggest fellows. So such things did not happen here, because here regulation should be based on the security, on the security you have. See, in a gold loan company, the security is 100%. Why do you need so much regulation here? Why don't you let people use this money and finally put purchasing power in the hands of people? How can an economy grow? Economy can grow only with consumption. So you read here also, In America, the consumption rate has fallen by 0.3%, so the economy is not doing well. In America, in US, the consumption or the spending has increased by 0.1%, so economy is doing well. So they all measure the economic activity through consumption. So in India, if you want consumption, you need to put purchasing power in the hands of people. You have to give them loans. Either you give them as free loans or you give them as other loans. What is a gold loan does, what a gold loan has done, they have monetized the idle asset which is in the people. The idle asset which is lying in the hands of people, it has been monetized and people are able to take a loan. They are getting purchasing power. The economy is improving. The economic activity is increasing. When more and more people purchase more and more goods, every activity will go up. That is how the GDP goes up. So these are things which regulators should also look at, where you should be able to propel the economy also. Propel the economy, not through too much of regulation, but regulation should be risk-based and also should have a practical aspect to it. That is my point here.
Okay, point taken. I don't want to engage in discussion. I'm more a moderator here, so yeah. So let us open the floor for some time, and then we'll come back to the panel again. But questions from the floor, and you can address it to any particular panelist, or just if you don't assign, then I'll keep it open for the panel to react. But go ahead. Maybe we'll take 3-4 questions and then go back.
What is the regular feeling about priority sector lending and the constraints and maybe regulatory constraints, or what are the banks facing in terms of problems regarding priority sector lending?
Priority sector, of course, the reasoning behind priority sector is to basically direct the lending towards areas where typically they are not getting funded because of various constraints which banks put in by way of entry criteria or whatever. So it was obviously implemented with, it has been implemented with the intention that people who are not getting regular credit should also be enabled to get credit. This was the idea behind the priority sector. So clearly it is doing its, it has done quite well in terms of all the banks, including foreign banks, were mandated to set aside certain portion of their lending activity towards priority sector. And there is also a constant revision which keeps happening in priority sector as to which one qualifies, which doesn't qualify. Earlier, there was a time when even large corporate agri entities were getting funded and they were all classified as priority sector, because generally what happens in priority sector is, because you end up giving at a very low interest rates, and also you are giving it to so-called unbankable sort of segment, the risks are perceived to be high. So, so typically in such areas you will end up actually having delinquencies in those portfolio. So, I mean, I'm not saying that it will definitely happen, but it's likely to happen. Therefore, now so there's a constant revision which is being made, and now whenever we write policy also, we are very clear that we need to meet up with this criteria, and failure to meet up that criteria will also make us to invest in RADF, I mean, basically these bonds which are very low yielding bonds. So in a way it is disincentivizing people from not able to reach the priority sector lending. So when we plan our business activity right at the beginning of the year, we are making it very clear that this is the closing book of the particular year. This much of priority sector lending has to happen, and each business head who are running various businesses are clearly told this much portion of your lending should be happening. So, but there are some changes which can be done in my view. Like for example, housing loan, for example, there was a criteria which was put that certain loans as in below will only qualify for priority sector. But with the inflation going on, etc., you can probably up the ticket size for which you can qualify them as priority sector. See, in places like Bombay, etc., if you put a 20 lakhs and all, you can't live in Bombay. You'll have to live some 50 kilometers, 100 kilometers away from Bombay because the prices are so high. So some of these criteria needs to be re-looked at, because not necessarily that they are relevant at this juncture. But of course, it's again, India being a very diversified country, in each location, the property prices are very different. Therefore, you can't really put one brush for everything. You'll have to be Similarly, the other area which continuously suffers in India is eastern part of the country, where not much of development activity keeps happening because the risks are perceived to be high, and not too many projects get floated there. Even people who have ventured there, they all had problems. Like some of the road projects, contractors from Andhra took these jobs in places like Mizoram, etc. They suffered because a lot of activities, disruption keeps happening. So in order to enable that these second rung, third rung, fourth rung towns also should grow, you need to facilitate credit flow into those locations. So it is serving its purpose, but clearly it is because it's mandated, banks are doing it. If left to bank, will they do this? Some of them may not do because it's not very lucrative, it is risky, all those issues are there. But like every other thing, there is scope for bringing in a lot of, like for example, when you're talking about energy efficiency things now, renewable energy, whichever we want to give thrust as a nation, you can actually direct such activities to be qualifying for priority sector so that lenders can then focus on lending in those areas. So that's how you can use this as a tool to direct the lending towards such areas. So that can be used as a slightly different model to bring in prioritizing what we want to do as a nation.
Ravi, you want to react?
Yeah, I will talk in general, adding something to what Murali said. Basically, if you look at this priority sector, why did it come? Because, before nationalization, what type of banks we had. After nationalization also, the banks became government banks, but then their attitude became little, not very conducive to be very proactive in lending to all these segments. And also that is why, India had this the directed lending concept, priority sector. We had lead bank scheme, we had SLBCs, in every state there used to be a bankers committee to identify. All these things are very fine. But basically I find that conceptually it is very good, but operationally there are a lot of problems. That is what happens, identifying the borrower, then the diversion of funds, the funds doesn't reach him. There are a lot of middle people in the process. So this, and also banks, from the bank side, if there are some subsidies and all these things to be done, this also doesn't properly get into the accounts of the beneficiaries, right in time. Third. And fourth is, if there is a delinquency, the state government, the recovery machinery and all, which should help the banks, that's very, not very, you all know who bankers are there, we say that there will be an adalat and all these things, but net, the recovery process becomes very slow. And especially for small finance banks like us, we have to have 75% of our credit in priority sector. So you can sympathize with us.
So that's the reaction I wanted from you, because
No,
it's
that's
not
what
a level playing field.
Yeah, it's not at all.
No, but it ought not to be a level playing field, because your objective of a small finance bank is very different from those of the
That
large
is right.
bank.
That is right. But then every other regulation is applicable to us. So then where is the level playing field there?
Small finance bank and commercial
We are
bank
a scheduled
regulations are
commercial
not on a
bank for
level
all
playing
practical
field.
purposes.
No,
We have to comply with everything, including the constitution of the board, the corporate governance principles, asset liability management, capital adequacy ratio much higher than
okay,
the
I'll
banks.
come to the corporate governance later. Let's have one or two more questions and we'll come back.
But if you look at the genesis of small finance banks, they were all predominantly microfinance entities. They were actually doing 100% priority sector.
Absolutely.
So from there, they've been given leeway to do 25% of non-priority. That's how I look at it.
Anyway, so any more floor questions and we come back? Yeah, I have I have my mic, so please go ahead. From the floor, anybody wants?
Let me then ask a question. So when we talk of financial inclusion, as an economist, I look at the demand side and the supply side. So we are mostly talking of the supply side. That is how to increase loans or increase savings. Even the regulator is operating on the supply side. But as bankers or NBFC companies, how much do you think, how much importance is paid to the demand side? That is to work on the customer's capability to manage their finances, repay the loans, or even work on fraud prevention in terms of awareness. So, of course, I know there are a lot of regulatory requirements which banks may be complying with. But do you think banks or NBFCs are going beyond that and doing this for improving their own profitability and to increase their own business, empowering the customer for better capability?
If you look at financial inclusion, activities, there are two. I will say there are two levels of financial inclusion, which is happening. One is the pure financial inclusion of opening more accounts and bringing more people into the banking outreach. That is one part. But the second part is, or equally important part of financial inclusion, is the financial education part. And this, I'm sure that Reserve Bank has been doing a lot of things in financial education, financial literacy. I was the regional director for Madhya Pradesh and Chhattisgarh, and the 2 years I was heading the RBI office there. The number of villages where we have visited, and schools and fairs. Everywhere we set up a booth and give a lot of publicity about what is the benefit of financial inclusion, financial literacy, financial capability of people. How do they look at the finances of a small enterprise? How they can manage it? So this is also part of financial inclusion. So it's not merely asking the banks to open some accounts for people and trying to do that. But the other part of financial literacy plus financial capability building, that also is part of the financial inclusion. Then only, unless we do both complementary side by side, and where all the banks in every state is a party to this, mostly it is done by the state level bankers committee along with the Reserve Bank of India in that particular state, along with, of course, the non-banking companies, everyone. So it's a big project, and perhaps we are one of the countries in the world where financial inclusion has been taken to such prominence by the central bank. We have a financial inclusion and development, FIDD, Financial Inclusion Development Department in the Reserve Bank of India, which is as good as banking supervision or banking regulation department, which is coordinating all these activities. And this literacy, you must have seen, many of you must have seen all these Raju and the Money Tree, like that, that book series which RBI has come out with. And then there are a lot of small videos which are educating people about the benefits of financial, inclusion, outreach and things like that. Yeah.
My response would be, see, I think fundamentally it has to start with educating the larger public about being financial, not only the basics of finance, but how to be a disciplined borrower. See, many times what happens is, in fact, the whole concept of microfinance came in with that, I think, in mind. When microfinance was started as a big activity, it was essentially to direct the funding, small amount of loans to a set of people, either it's in a village where 12, 15 of them come together and they get funded as a group, and then there is a sort of discipline put in by the small microfinance company to say that repayment will have to be done, and it works through the peer pressure, it works through each one helping the other, so that they can start a smaller economic activity. And today, there was a bureau which was actually formed, original bureau of high mark, which eventually became one of the big bureaus now. It was started with the idea of where microfinance companies had put in equity in that, and they started a bureau. So I think, in my view, inclusion or any of this will have to be done holistically. By just doing it at a very superficial level is not going to bring in the fundamental change required. Today, one of the big asks, if you ask me, at a school level, even at a college level, I don't think there is a basic course on finance education today to students. People pass out from, I'm amazed at some of the doctors who are practicing for years don't have the basic finance knowledge. They are so illiterate when it comes to financial discipline or financial understanding. I think for this to change, I think a whole lot of initiatives to be taken. I think we have taken as a country few good initiatives like microfinance. The whole thing came up now. Microfinance have become small finance banks, and today there are very good small finance banks which are doing a wonderful job of funding many small time entrepreneurs, many small time artisans, etc., who are getting funded at a reasonably, relatively cheaper cost in comparison to what otherwise they would have borrowed from a typical money lender by paying exorbitant interest rates, etc. I think that's already happening, and with the bureau coming in with a discipline that if you have a good bureau score, there is no limit to what credit you can take, etc. I think has brought in a lot of responsibility even amongst the borrowers. So financial literacy, which sir talked about, is again something which we keep whenever we look at customer as a part of customer service committee discussion. We look at how many financial literacy centers have we started, how many. But some of these are also done because regulatory they are wanting it to be done. But is it really reaching the requisite level? Answer is no. But in my view, anything which is done just to tick box will not help. We will have to actually do it with a good intent to. And this is where I think now with the technology coming in, making it possible, with the BCs now coming in, with the BCs also getting technologically savvy, I think the reach out to the real needy will be far more now. And banks have also, to a large extent, have already exploited tier 1, tier 2. So the new business they will have to look for is coming from tier 3, tier 4, tier 5. Therefore, hopefully all these will bring in a lot more disciplined customers. See, today credit penetration in India, even as we are talking, is still very low. So we have a huge runway to run. So I think we are moving the right direction. I think technology can be a big leveler for this.
So I have my thing. Let me change the track a bit. And I mentioned this earlier that corporate governance we'll have a discussion on. To my mind, it is one of the most important issues for regulation and ensuring systemic soundness, as well as, more importantly, intermediary soundness. So here, one is the issue of independent directors. Are they really independent? Can we make them independent? Would they have the right fit and proper criteria meeting, like in the sense they bring in some expertise which is necessary for the business of the banking? The second is, how do we field corporate governance in more family-run businesses? And we have a lot in Kerala, and maybe you can react to it. So how do we handle that?
Thank you. I think I will start with our own company's example. Corporate governance, Muthoot, we were initially a partnership firm. It was called Muthoot Bankers. It was Muthoot Partnership. It was maybe generations and generations of Muthoot Bankers, partnership firm. So probably in late 1990s, Reserve Bank came up and said, you cannot run all these partnerships where there is no visibility in the Reserve Bank about what Muthoot Bankers is doing. So you have to convert yourself into a NBFC. So we converted to NBFC. And then probably in early or late 90s, we became NBFC. Then it became a company. Then we started growing. We started branches also. Now I'll come to the more important corporate governance part of it. The corporate governance first was a regulatory corporate governance. That is the Reserve Bank asking Muthoot to become regulatorily the corporate governance okay. When after running the company, we wanted to go for an IPO. So it was maybe in 2006, we started talking with investment bankers for a IPO. Initially, I was also I was much younger at that time. We were started dialogue with all the investment bankers. All these investment bankers from abroad used to come, private equity used to come. They all will come and they actually want to know what is the amount of corporate governance you have, or something like a transparency in the company. Does everybody know what is happening in the company? If I am investing in your company, what type of visibility will I have about I'm talking not about the regulatory compliance, I'm talking about investor comfort. So they want to know, if I invest in Muthoot, will Muthoot actually shortchange me? Will they cheat me? Will they have a good governance? So that is what is most important there. So only when, at that time is then we started even without the regulatory requirement, we started bringing in independent directors. That is, other than the family, other than our brothers and family members, we started bringing independent directors. The independent directors are there to see whether the interest of the other investors are protected. The interest of the other stakeholders are protected. Not only the investors, maybe the lenders like banks, maybe the regulators, etc. are protected. So the corporate governance aspect, not only from a regulatory angle, from an investor angle is also very important. So nowadays, small companies come to us and say, why don't you invest in our company? Why don't you take over a small company, etc. The immediate thing we also look is, what is their level of corporate governance? If I go and invest in XYZ company, what is the comfort I am getting whether the money which I invest is safe? So I think corporate governance is becoming more and more relevant, not only from the regulatory side, from an investor side also. If anybody wants to, if a foreign company is coming to invest in a company in India, they will first look at the corporate governance. Who are the people behind this company? Who are the people who are running this company? Are they honest, truthful, reliable people? Will they, after I have invested my money, they just say, you go away, I am taking my company? That is not what is expected. So corporate governance is most important in that aspect for a company also. If their company wants to grow, if a company wants external investors, whether it is an equity investor or even a lender, they need corporate governance. I think that is the importance I have personally felt in corporate governance. And today, in our company, there are 6 family directors and 7 independent directors. That's not, it's only one part of corporate governance. That is the level of corporate governance, and that's the level of comfort people want to see. Unless they see a transparent or a company with good corporate governance, the investors will not look at investing more in that company. Unless more investors come, the share price also won't go up. So for a company where the share value is or share price is going up, it presupposes that the corporate governance is better. If the corporate governance falls, you have seen so many companies where overnight you will see the share price dropping like this, falling like what, 9 pins. It is because something has happened in the corporate governance. So I think that's my personal view of this.
I would say that's music to the ear, coming really in that sense. And Murali wants to react. Murali, also, we have these issues today. Uday Kotak has resigned, and also we have Dhanlakshmi Bank issues on the fore. Any particular reactions on how these things should be handled?
As far as our bank is concerned, there is no promoter holding in our bank. The highest promoter can hold is only 5%. Therefore, there is no promoter group in South Indian Bank. The board is full of independent people. We call some of them as independent directors, some of them as directors. Otherwise, all of them are professionals, and there is no promoter representation in the board. So therefore, I work with a board which is completely independent. There is no promoter group which is sitting there. So therefore, and that's one of the things which I as a professional looked at when I wanted to join an organization. Why? Because it works both ways. If you have a promoter group, there are some advantages of promoter sitting inside the board. There are some disadvantages of promoter sitting inside the board. Not to specifically talk about Muthoot group, but let me tell you, there are promoter groups who actually sit there and ensure that their interests are taken care, even at the expense of somebody else's interest. That's where I think some of the promoter groups also carry a disreputation, I would say. But coming back, I think corporate governance, in my view, is very, very fundamental, because at the end of the day, we as an institution, we are playing a role in a society, and we have huge stakeholders. And the stakeholders, starting with employees, are stakeholders. Today we have 10,000 plus employees in our bank. So obviously 10,000 families, 10,000 people and their families are dependent on how well the bank is run. So employees is one stakeholder. Then you have regulators are one stakeholder, because if we run in an irresponsible way, obviously we'll be doing a lot of damage to the society. So regulators, our own lenders, we also borrow from lenders. So we need to ensure that their interests are protected. Our investors, shareholders who actually put in money, And there are different types of investors. We have institutional investors, we have retail investors. So we need to ensure that their interests are protected. So like this, we also have to work in the midst of many stakeholders. So anything which you try to do where it's only favoring one set of stakeholder at the expense of another set of stakeholder is not considered to be a good governance. Obviously, you can't please your employees by giving them more salary, more bonus, more increment, but not having enough capital to plow back and grow the organization. Obviously, you are being unfair to the equity investors. And like that, I mean, we can give examples as to why skewing on one side will affect the other. So therefore, in my view, corporate governance is something which is very fundamental. If it's not there, it can do a lot of damage. Okay. Having said that, the other important thing is the question which the professor asked, whether independent directors are indeed independent or not. See, finally, at the end of the day, there are professionals who don't act professionally. Let me put it this way. There are professionals who, come what may, they are very clear that they have been taken for their value addition into the board. So they will speak their mind, they will call spade a spade. If something is not right, they will point it out, say this is not right, please correct it. But there are professionals who, when they are wanting desperately to be sitting in a board and they don't want to antagonize an executive, or they don't want to antagonize a set of executives who are sitting in the board, they would while they might voice, but at the end of the day, they will fall in line with what executives would want to do. So again, then you are being unfair to some and fair to some, more than fair to somebody. That's where I think this disequilibrium comes in. So therefore, how independent are independent directors? In my view, RBI regulators are ensuring that these people play the role, because there are a lot of owners today on independent directors also. Today, when I retire from this bank, when I want to take up independent director role, I'll have to be very sure that I join an entity where there is good corporate governance. I don't want to get sucked into an organization where something bad happens and I'm going to be answerable to that. So I think even as people who would be joining organizations to contribute our experience and knowledge, we look for governance in those organizations. So connected with governance is what Alexander sir spoke about: disclosure, transparency. How open are you in communicating with your investors, with your analysts? Today, one thing which I can tell you, I keep facing analysts and investment bankers every now and then, and they are extremely smart individuals who come and really tear you apart. You can't be bullshitting, in short. So you'll have to be very clear on what you need to talk. You need to be knowing what you are doing. If things don't happen, you need to be transparent, tell them that this is something which we attempted, but it's not working and I'm going to do this. The more you are transparent and tell them what you are actually doing, I believe that they value a lot. It's not necessarily that your bank might be run exceedingly well, but the fact that you are disclosing everything gives them a big comfort that you are trustworthy. And eventually, corporate governance ensures that all the stakeholders have trust in the organization.
I just wanted to add one thing only here. When you talked about investor, I think it is about 15 years now since our company has gone public. 15 years means 15 into 4, 60 quarters. 60 quarters we have published our results, and soon after the result is published, in 2 hours, we have an investor conference. The usual number of people who join the investor conference is 175. 175 people are there to listen to what I said. They will ask so many questions. Why is that? Why is this? Why is the NPA like that? Why is the NPA not coming down? What are you going to do there? Why is that? Why is that? It actually, as he said, some of them actually question you. But then at the end of the day, when they feel that we are answering their questions, we are transparent with them, they really value the company. They value the company, and that is definitely my experience. I have sat through, other than one of these this investor conference, all the 60 I have attended, and probably with my team, I have been answering all these questions. Not that 150 people will ask questions, at least 35 people of them will ask questions, 35 people, and 150 are listening to it. And next quarter when I go, they will ask, last quarter you said like this, why it has not happened? My God.
I got it.
My
so
God.
That's something positive. But let's see.
It's all recorded. You can see our analyst call. If you go and Google SAB, you can see Q1, each Q results, quarter 1, quarter 2 results, analyst call, verbatim what I spoke. Generally, from our bank, I answer all the questions. And my first investor call was attended by 60 people. My last investor call was attended by 300 plus people. That shows the interest people have towards a bank. It's a sign of the fact that the bank is looked at by more investors.
Ravi, your reaction, because you have done so many FSAPs. So corporate governance is a big issue. And how do you rank India? We don't have a Sarbanes-Oxley Act. We do have a clause 49. I mean, where do we stack up on corporate governance?
Yeah. If you ask the question, where do we stand on corporate governance as far as the banking sector is concerned? We don't need a Sarbanes-Oxley Act, or we don't need a Dodd-Frank or anything, because we have a document which is of 1949, the Banking Regulation Act. And what is there in Banking Regulation Act, what was drafted in 1949, remember 1949, whatever you are talking about corporate governance after the global financial crisis is there in this 1949 Act. I will give you a personal example. After this global financial crisis, I will take 5 minutes, you cannot stop me.
I can.
After the global financial crisis, there was a committee set up by G20 to look at the transparency and regulation. I forget the exact name of the committee. Our Deputy Governor, Dr. Rakesh Mohan, was the co-chair of that committee, along with the Canadian Deputy Governor, Tiff McCallum, who is the current Canadian Governor. And Dr. Rakesh Mohan had specifically asked, I was in regulation department, he had specifically asked for me to work with him in that committee. And all these G20 countries were members in that. So we drafted, so India and Canada were the co-chair, so we drafted the report. And at the end, Dr. Rakesh Mohan told that this is one of the best reports which I have been chairing of the committees. Anyway, that's a different thing. So when we drafted this report, it covered everything. And whatever now you are talking about after the global financial crisis came up, one of the most important document which was the origin for this has been this committee report. I think you can Google and read it in the net. So it contained compensation, it contained corporate governance, it contained all the regulatory reforms. So when we were looking at corporate governance and compensation, these two issues, so we told Dr. Rakesh Mohan that sir, these things are there in the Banking Regulation Act. Being an economist, being some person who came to the Reserve Bank at the level of Deputy Governor, he said that, are you sure? I said yes, because I was in charge of legislation division in DBOD, which is the one concerned with amending the act and all those things. So we took the Banking Regulation Act and took it to him and read it out. I will tell you, there are provisions. When you get time, at some point in time, Google the Banking Regulation Act and read it. You read it and you will appreciate how good a document that is on corporate governance. There are sections, section 10, section 35, section 12 on the voting rights and the other things, And we also have a section saying that the appointment, the reappointment, the terms and conditions of appointment, and the termination of appointment of a chairman of a bank will be decided by the Reserve Bank of India. 1949, remember.
But
and
during the
crisis.
No. I just have one question on this.
During the crisis, what happened? Many of these countries, the chief executives and the chairman, the bank was doomed, but they escaped with a lot of dividend and bonuses. But in India, this did not happen because these things were approved by the Reserve Bank of India. So the banks had to come to us. So at some point in time, when you look at the corporate governance practices in India, the Banking Regulation Act and compliance with Banking Regulation Act is the best evidence of corporate governance.
That's one view you have given me. Let me say we are kidding ourselves, because with 75%, 3/4 of the bank being state-owned banks, none of those applications really apply to public sector banks. So please react to that.
I'll come to that also.
Also, I have a view on compensation.
Yeah. So, basically, he says the right point. There are public sector banks, so how does this corporate governance apply? Remember, the public sector banks are formed by the Banking Companies Transfer of Undertaking, Acquisition and Transfer of Undertaking Act, which is in short for the Nationalization Act. There are many provisions in that, but the Banking Regulation Act has got some enabling provisions which applies to public sector banks also. If you look at the last part of the BR Act, it says section, I'm just giving an example. Section 35, 45, 47, 49 will apply to all type of banks. So many of these provisions apply to them also. But then naturally, when they were fully owned by the government, the directors were appointed by the government, the MDs and CEO were appointed by the government. But slowly now, they are getting diluted. There is private ownership in these banks. So when there is private ownership in these banks, there are directors who are elected by the shareholders. So it is not, all the directors are not, and there is also a condition that independent directors should be there, one. And one thing that RBI could get out of the government is, you appoint the directors, no problem, but we will do the due diligence. We will do the due diligence. And government agreed at some point in time. So even if the government wants to appoint a director on a public sector bank, the due diligence will have to be done by the Reserve Bank of India. And we do due diligence with the same rigor with which we do the due diligence of South Indian Bank or ESAF Bank, So, petrol pump owner cannot be a director. The petrol pump owner
Point
story.
taken.
Yeah.
So that's okay. I hope, supervision is basically agnostic to the ownership. Regulation is not. So that's how I'll put it. But anyway, let me come back. And I think we're running out of time, so we should give floor time. So very quickly, two of you, like one, when you are leaving your bank, are you satisfied with the massive transformation? We are really enamored by it, but is there an unfinished agenda you would leave behind for your successor? And two, I'll ask Alexander on where do we go? I mean, he has revolutionized gold banking in India, but where do we go from here? And that question was asked to you in some form. So are you willing to diversify? Are you willing to sort of go into a modern NBFC in every sense, or you think your niche space is more important?
No, let me first quickly touch upon the compensation. See, I do agree that 2008 crisis brought about the fact that many of the CEOs were having huge compensation, and their compensation did not get affected when the bank went down under also. So they all walked away with huge bonuses, which clearly was excess. Clearly, because the variation between an average salary of an employee to the CEOs of such large entities were hugely, I would say, skewed. So therefore, obviously, they walked away with a huge bonus, which clearly is not something which is acceptable, especially when all the other stakeholders have lost money. An employee alone or a CEO alone walking away with such huge bonus, clearly not acceptable. So clearly there is a governance failure, if you ask me. While correcting that, we here in RBI, in India, we brought in this system where salaries and compensation of today chief executives or MDs of the banks are decided by Reserve Bank, and they actually are getting into like a bank like ours, for example. It's a fully privately owned bank. There is no government stake, there is no this thing. But here, because they decide the MD CEO salary, clearly his salary cannot be lower than employee salary, which is obvious, right? Therefore, you end up actually having lower and lower and lower and lower salary for the 10 layers which you have. Finally, the salary which you offer to the lowest person, you will only get a donkey. You won't get a horse. So today, when you run banks, you actually run a systemic risk of running an institution with donkeys. No offense meant. I'm actually telling you, when I say donkeys, I mean people who are completely fresh and raw, without the ability, and how can you put them as a branch in charge when they are supposed to be CEOs of that bank in that location? They carry as much responsibility as a head of the bank, which I carry. When I am responsible for 10,000 plus families and the society at large, that person is responsible for people who bank with our bank in that location. So he has to be good. While you can put the onus on management saying that you will have to train your people, you will have to do everything before you send them, etc. All that is there. But at the end of the day, my simple this thing is, you can't move from, in Tamil there is a proverb, you can't have kudumi and then if you don't want that, you want to shave the full head. You can have a normal hair. It doesn't mean that you will have only jittu and clean shaven hair. You can be in between. Therefore, I'm saying, I think somewhere in between the balance has to be there. And this is one aspect. Second aspect is, after having done well, they sit on it and they say, no, no, even if the board recommending certain variable and certain fixed, they play on this and say, no, no, we'll have reduce here, reduce there, reduce here. I really don't understand. If you keep tampering with that, how will you be able to attract good, well qualified professionals to come and turn around banks? There are many banks which require good people to run those banks to turn them around. They are not run well today. We need good people to come and run them. How will you attract good talent if you don't compensate them adequately? That's a basic question. I think this requires, I'm not expecting answers here, but I think these things will have to be thought through. Second thing is, even if you give a variable, they say that it has to be staggered over 4 years. Very, very good logic. You can't do short term and take away their bonus and incentive and make the institution suffer, which is a logical thing. Therefore, you need to but then by the time they decide to give you, it takes 1 year. So next March only I will be looking at bonus for my previous March. While RBI is very particular that you need to do everything within 90 days, 20 days, 120, but they don't have any such thing.
Even if you retire, next person is doing a donkey's job, you won't get your bonus.
Correct.
First class.
So these are all aberrations. In my view, these are all aberrations, I think, which requires correction. Okay, now coming to the next question which Professor asked about turnaround. See, this bank was run in a very different way before I took over. I had worked in ICICI for 21 years in various parts of the bank, both in India and outside of India. So I had headed international business group of ICICI for North Asia, Middle East, Africa, Sri Lanka, where I was handling 20 billion balance sheet. So when I retired from ICICI, I got offers as MD of few banks and I chose this to work, primarily because this board did not have a promoter group. That's why I joined this bank, because I know that I can actually implement what I wanted to do. When I looked at how the bank was run, it had lots of issues. The bank was literally, when I did a comparison of this bank with all the peer banks, this bank was featuring as either the last or last but one in almost all the parameters. Be it capital adequacy, be it GNPA, net NPA, provision coverage ratio, cost income ratio, CASA. You look at any parameter which a bank is assessed today, this bank was either the last or last but one. And I joined this bank basically to contribute to make a change in this bank. And I can say that I joined during COVID period. So 3 years stint of mine, I was inside COVID for 2 years. So I actually had the first normal year, the last 1 year only. Till then I was doing lots of changes in the bank. Literally the bank has been, I've done a surgery of the bank. That's a way to put it, because every area of the bank we have changed. Every area. Be it branch structure, be it asset structure, be it policies, be it processes, be it committees, be it credit underwriting, be it bringing model for credit underwriting, using bureaus, using various external tools. We have done co-lending, we have done securitization, we have brought in lots of new products. I have created a lot of new divisions. We created a lot of new divisions. Data science is a new division. Learning and development is a new division, where we have come out with a lot of e-learning modules to basically educate our employees before they are put on the jobs. And these e-learning modules have now been made available in mobile. So the person joining a bank can sit in his own place and learn about working capital financing, learn about investments. I can be honest with you, people who pass out from even decent campuses, they don't understand what a balance sheet is. I'm sorry to say this. I asked this question specifically during interview. There are people who have done MBA, and when they ask them, is a net worth an asset or a liability, they blink. This is the level of, and I'm surprised that they have gone through so many courses in finance, so many, the regional head of mine is sitting here, he knows how I pile on to people when I ask these questions, and such basic questions they don't have answers to. I think somewhere we study about many advanced things, but then we don't really relate to the basics which are required to be understood. So I think, so these changes have actually brought in a lot of good to the bank. Suffice to say that in March 23, we did this bank is 94-year-old bank. We did our ever record highest PAT, highest NII, highest NIM in the history of the bank. And and our capital adequacy, which was sub 13, today it's at about 17.25. And our CASA, which used to be sub 25, today it's at about 33. Our provision coverage ratio, which used to be at 32, excluding write-off, today it's at 65. In every parameter, we have come a long way. In fact, I drafted a vision document in 2020 September, as per which we had laid down certain milestones which we needed to reach by 24 March, which we pushed it by 1 year due to COVID. And I'm happy to say that in every parameter, we are well on our way to reach those numbers.
Your stellar performance will go down in the history.
And market has
and
also
maybe
rewarded
we'll-
us with a good appreciation in our equity price. When I joined, the bank was at 6.7 rupees. It was considered a penny stock. Today it is at 23, 24. So it has given a return of 200% in last 1 year.
Thank you.
How many shares did you invest, sir?
I have 0 shares, but I have lots of ESOPs.
You did not invest.
I didn't invest. Anyway, I know I will get a lot of ESOPs.
Please.
What is it you want? I forgot all this.
About transformation of your NBFC. Yeah.
Transformation.
Yeah.
So
From the success of the gold business to now more diversity.
this is a question which I keep answering every quarter. At least in the last 3 years, every quarter, all the analysts will ask me, when are you becoming a bank? When are you applying for a bank? This is a questionnaire. So I have to give you the same answer, I think, too. So they always ask me, when are you becoming a bank? Why don't you convert yourself to a bank, etc., etc. So I've always felt, or the board has always felt that as of now, we are comfortable. The shareholders are comfortable. The shareholders get good dividend. The investors, the banks, etc., are comfortable. We have a lot of, what should you say, headroom to grow also. So we don't actually require a bank license. A bank license can only probably give us access to deposits, or as you say, CASA, the current account and savings bank deposit, which is very low cost. But in today's world, I think we have a AA plus rating company. I'm sure in the very near future, we should also get a AAA. Once Muthoot gets a AAA rating, we can access wholesale funding at almost savings bank rates. Almost savings bank rates, we'll be able to access credit in wholesale market. So in that sense, the advantage of a deposit is not going to be of a big use to us. But then we have little more definitely flexibility. As he said, we can appoint our own directors. We can pay them reasonable salary. We don't need RBI permission, as Murali said. If they recommend for a new CEO and say, yes, we paid 5 lakhs, they'll say, no, not 5 lakhs, why don't you 3 lakhs? And you have to, I think, bargain with the regulator. My God. Anyway.
We can't bargain with them. We have to only accept what they say.
At least you can dialogue with them.
We'll have to have an alternate job before we argue with them.
Okay, so
Here, please. I am at IIM now.
So I think we, because today 75% of the company is owned by the family, 25% is outside. So we have a proprietary interest in the company. So when Murali said he has joined South Indian Bank just because there's no proprietor sitting inside there, that is why he joined. So probably he may not join Muthoot. No, I was joking only, sir. I was only joking. An owner who has stake in the company, when he is also there to take decisions, I have always felt that he will take the decisions in the best interest of the company is what I always feel. Because for every 100 rupees, 75 is lost by me. Only 25 is lost by the others. Whereas if it is a fully public company, your investment may be 3%, 4%, and 95% is somebody else. So I think the level of the nitty-gritty you will look into before taking a decision is better with when the proprietor is also there.
Got it. Any quick, short, last word from your side? Yeah. Small finance banks.
No, not from the specific issue of small finance banks, because corporate governance is equally applicable, just like any other bank. But only thing is, I will just add one thing to what Alexander said. in corporate governance, you have, these Basel principles of 2015. So principle 1 talks about the role of the board. So in that, it brings out two principles. It says duty of care and duty of loyalty. So duty of care is that you will approach the affairs of a company as if a prudent person will approach his own affairs. So that is the advantage if there is a promoter group and he is on the board and he adheres completely to this duty of care and duty of loyalty principle. If he doesn't, then that's a different story. But if he does that, then the corporate governance becomes at a much higher level, because he has got a lot of money put into the company. So he would not like to abandon the principles of duty of care and duty of loyalty. That's the fundamental principle in corporate
That's a
governance.
fabulous closing remark. I mean, I must say it's. But before we close, some one or two floor questions. We have run out of time. We need to close it. But any more questions from the floor? Okay, then let me close, but seek a one-liner remark. How do you see the future of Indian financial system?
To me, one-liner, Indian financial system is quite strong. We can be compared with any other Western economies. Our controls, our regulators, our financial system is as strong as any other, and we have actually proved that in the last 20 years. We have not had any major banking, problem here in India in the last 20 years, 25 years. I think that shows, that is a proof of what our system is, and I'm sure this will go a long
Only
way.
on the back of almost 4 lakh crores injected by the capital on the fiscal space.
Yeah,
So,
that is no issues.
no
sir.
failures.
No failures, yeah.
No, I would say when we are marching towards 5 trillion economy and 10 trillion economy, and with India today being the forerunner in coming up with a tech stack, which is actually we are forerunner to many of the countries, even in South Asia or Middle East, etc. And rupee is now an accepted currency for making payment with some of the countries. I think India is actually on its way to becoming recognized as a solid global player, with more and more role being played by our government in many of the affairs of international affairs. I'm sure we are in for a great time, and I think all of you who are starting your career in a year or two from now, you have a fantastic future. But for all this to happen, I think you should be completely diligent and sincere about learning it properly, and invest in yourself every day, not just in financial, functional capability. Please invest in other activities, soft skills. All these are required. Today, more than ever, I think the hunger to learn has to be far more than what we all experience. There was a time when everything used to be renewed every 3 years for us to be relevant. Today, if you don't renew yourself every month, you will be irrelevant. This is what you are actually seeing in technology area, in software area, where if you don't know particular programming, you don't get a job. So that is actually going to happen. So please continue to have huge hunger for learning and invest in yourself so that you really play a big role in the future of India. I think fantastic future for the country is what I believe. Thanks.
Okay, you are all students. So I will have a comparison. So when are you doing very well? Or when are you a super student? You are a super student when you do extremely well, isn't it? Or you do average and all others do very badly, isn't it? In that case also you are very good. So in our case, we have been doing I will not say super, we have been doing reasonably well, but our peer group, in emerging markets, they have been doing very badly. So this combination of these two things makes us look as if, we are the most, sought after economy and things like that in the world. There's a combination of these two. I'm not saying that we are not doing well. We are doing well. We are doing, not super well, but we are doing well. But many of the countries with whom, emerging market economies where people used to invest and all, they have all gone down the drain. So, that's an advantage for us in a different way. But then, like Rajeshwar Rao said in the morning, there are a lot of challenges. This particular year, the monsoon will be a big challenge. And then, you do not know after the last quarter, last 1 year, the banks have been doing very well. The NPAs have come down. but there are some restructured accounts for many of the banks. So we do not know after 1 year, 2 year, what is the performance going to be. So if there is some deterioration in the economy, if there is going to be some political uncertainty and all, then things may turn very adverse. But as of now, let us not worry about the past or worry about the future. Let us talk about the present. The present is very good. So as the going is good, let us be part of that and enjoy it. That's all.
Thank you.
From Reserve Bank, you never get a very good compliment. Reserve Bank comes to us and the banks for inspection. And they write so many things. They will never write, this company is doing well. It is a good company. Never. They have never, not only our company, nowhere they'll write. If Reserve Bank has not given any adverse comment, consider it is good. They will have, will you give a comment?
Very good.
No, they will never write. This company is good, this company is, this is good, that is good. They will never write. They will only say, they won't say anything means that is good. So when he said, you are not good, you are just below the average and the others are below the average. He will not say that you are good. He only said you are average, but the others are below you.
No, but thank you. I don't want to prolong this because it has been such a wonderful discussions. And I thank all three of you for taking time out here, coming and giving very frank, positive, also very mature thoughts. So thank you very much indeed, and hope we'll engage you.